Please take a moment to like and subscribe to the show so you never miss an update. Imagine, for a second, going to work at a restaurant, and before you can even serve your first table, the manager tells you that you need to go to the store and buy the silverware, the napkins, and the glasses out of your own pocket.
Which is, frankly, ridiculous, especially when you are the lowest paid employee in the entire building.
Exactly. I mean, you would probably walk right out the door. But today, we are exploring a sector where this exact scenario plays out every single day, which is early childhood education.
We are analyzing House Resolution 5334, officially known as the SEED Act of 2025.
And for this discussion, we are pulling from actual legislative drafts, official committee reports from the House of Representatives, macroeconomic tax analyses, and, some international educational policy comparisons.
The mission here is to really break down exactly what this legislation does, who it targets, and, well, the broader economic ripple effects it triggers for you and the economy.
Right, so to really understand this, we need to look at the fundamental issue driving the legislation.
Yeah, we are dealing with a long-standing statutory discrepancy within the federal tax code regarding who officially gets to be called an educator.
Because, for over 2 decades, the tax code has maintained a very rigid boundary that grants a specific financial benefit to one group of teachers,
while completely ignoring another group doing substantially similar work in the foundational stages of a child's cognitive development.
Okay, let's unpack this. The primary motivation behind House Resolution 5334, which was introduced by Representative Jimmy Panetta of California, is entirely about correcting what the sponsors view as an arbitrary exclusion.
Right. Representative Panetta and the bill's backers are targeting a specific loophole that has existed since 2002.
Yeah, 2002 is the pivotal year here.
It is. In 2002, kindergarten through 12th grade teachers were granted a specific above-the-line tax deduction for out-of-pocket classroom supplies.
But early childhood and pre-K educators were completely excluded from that.
Completely. The federal tax code strictly limited the definition of an eligible educator to someone teaching K through 12.
So you could have a situation where a pre-K teacher is working with 4-year-olds in the exact same elementary school building,
holding the exact same state credentials as the kindergarten teacher next door.
But the tax code refused to recognize the pre-K teacher as an educator for the purposes of this specific deduction.
Which brings us to the stark financial reality for the people caught on the wrong side of that exclusion.
Yeah, our sources highlight that early childhood educators are earning a median wage of just $13.07 an hour.
And at the exact same time, they are spending an average of $860 of their own non-reimbursed money every single year on basic classroom supplies.
They're buying developmentally appropriate books, fine motor learning tools, and even basic sanitation items just to keep their classrooms functioning.
Going back to your restaurant analogy, it really is like expecting the busboy to purchase the dining room's napkins out of pocket just to keep the business operational.
It makes you wonder why child care center operators do not simply cover the cost of these supplies themselves.
Well, when you look at the economics of the childcare industry, you start to see why this market failure exists. Childcare is essentially a private market trying to supply a public good.
And operators face an absolute ceiling on the revenue they can generate, right?
Exactly. They cannot just continuously raise tuition. If they raise prices too high, they basically price working parents out of the workforce entirely.
On the flip side, their operational expenses are rigidly locked in. Labor costs consume 60 to 80% of their total expenses.
Because of the strict staffing ratios. To keep children safe, the law mandates strict adult-to-child ratios.
You cannot put 20 infants in a room with one adult.
Right, you need one adult for every 3 or 4 infants. So because the market cannot sustain higher tuition and you cannot reduce the headcount of the staff, the margins are razor-thin or non-existent.
So the lowest paid workers in the entire education sector end up personally subsidizing the operational overhead of the industry out of their own meager paychecks.
Which leads us directly to the proposed fix.
Right, so what is the estimated cost for the government to finally offer these early childhood educators a tax break of up to $350?
We have a detailed fiscal score from the Joint Committee on Taxation, which is the nonpartisan congressional authority for revenue estimation.
And what do they find?
They calculated that enacting House Resolution 5334 will result in a $648 million reduction in federal revenues over the standard 11-year window, spanning from 2026 to 2036.
I look at that number, $648 million over more than a decade, and in the context of the federal budget, that is essentially a rounding error.
But you also have to consider the macroeconomic environment. The federal government is facing a projected $3.5 trillion deficit expansion over the next decade.
True, so every single dollar of revenue loss is highly scrutinized by budget analysts right now.
Yet, despite that scrutiny, this bill has achieved massive bipartisan momentum.
And the probability of passage looks incredibly high. This bill advanced out of the House Ways and Means Committee with a unanimous 43-0 vote.
Which proves that advancing legislation is a straightforward process when there is uniform agreement.
A 43-0 committee vote across ideological lines indicates absolute, unified backing. The bill currently has 23 co-sponsors spanning both sides of the aisle.
Representing everyone from high-cost coastal areas to rural Midwestern districts.
There is also a companion bill currently moving in the Senate, Senate Resolution 2791, sponsored by Senators Michael Bennet and Susan Collins.
What is fascinating here is how the bill actually defines an early childhood educator to prevent tax fraud.
Right, during that unanimous committee markup, they adopted an amendment in the nature of a substitute.
Which sounds technical, but it basically means the committee swapped out the original text for a revised version to tighten up the language before sending it to the floor.
Okay, so they rewrote the definitions in the Internal Revenue Code to carefully box in this new tax benefit.
Exactly. To be considered an eligible educator under this new framework, you must work at least 900 hours a year in a facility that cares for more than 2 children under the age of 6.
And that facility must operate for a fee or at the public expense.
But those specific definitions immediately triggered a major debate surrounding IRS compliance and administrative burden.
Because broadening the definition to include informal or home-based daycares introduces an enforcement challenge.
Right. Enforcing a 900-hour threshold for an informal neighborhood daycare could severely stretch auditing resources.
Verifying those specific hours for an unregulated home-based business is inherently complex.
So tax administrators warned this could essentially turn into an honor system deduction.
And historically, whenever you introduce an honor system deduction into the tax code, it leads directly to non-compliance, unintentional errors, or aggressive claiming by unqualified individuals.
But you really have to ask if the Internal Revenue Service is going to deploy its auditing resources to investigate a $350 deduction for a child care worker making poverty-level wages.
Right. If I claim a $350 deduction, the actual tax revenue the government loses is a few dozen dollars. The sheer cost of paying an IRS agent to enforce and audit that specific deduction would vastly exceed the actual revenue the government would recover.
This raises an important question about the aggregate integrity of the system versus the individual benefit. Does the mathematics of this deduction actually help the educator in a meaningful way?
We are seeing significant critiques from progressive think tanks like the Brookings Institution and the Center for American Progress on this exact point.
They argue that the very mechanism chosen for this bill, an above-the-line deduction, is inherently flawed when you are trying to assist low-income workers.
So what does this all mean for your wallet? Look, let's translate the math. Say you are an early childhood educator making the median wage of $13.07 an hour.
That gives you an annual gross income of roughly $27,000.
When you file your taxes, you take the standard deduction, which for a single filer recently has been nearly $14,000.
By the time you subtract that standard deduction from your $27,000 income, your actual federal income tax liability is already at or near zero.
You simply do not make enough money to owe the federal government income tax.
And that is the crux of the think tank critique. An above-the-line deduction lowers your adjusted gross income before you calculate your tax liability.
But if your tax liability is already zero, lowering your taxable income by another $350 provides almost zero mathematical benefit.
Exactly. If you are in the 10% tax bracket, a $350 deduction from your adjusted gross income only yields about $35 in actual cash savings.
You are spending $860 of your own money on classroom supplies. The government passes House Resolution 5334 with massive bipartisan fanfare, and your reward is a $35 reduction on your tax bill.
That mathematical limitation is precisely why policy analysts argued this is hollow benefit. It sounds substantial on a political press release, but the macroeconomic impact on the educator's daily financial reality is statistically negligible.
We can look to state-level precedents to see an entirely different approach. States like Colorado, Louisiana, and South Carolina bypass this exact problem.
They do it by offering fully refundable tax credits instead of deductions.
A refundable credit operates completely differently from a deduction, right?
Entirely differently. A deduction reduces the amount of income you are taxed on. A refundable credit is a direct dollar-for-dollar reduction of the tax you owe.
And the refundable part means that if the credit drops your tax liability below zero, the government actually cuts you a check for the difference.
Ensuring that the educator actually receives the full financial value of the benefit, even if they owe absolutely zero taxes at the end of the year.
But there is a fascinating hidden mechanic in how state and federal taxes interact that we found in our sources.
Right. For educators living in the 36 states that tie their state tax calculations directly to the federal adjusted gross income, this federal bill will automatically trigger a secondary tax cut at the state level.
Let's break that down. When you file your state taxes in those 36 states, the very first number you write on the state form is your federal adjusted gross income.
Because House Resolution 5334 creates an above-the-line deduction, it legally lowers your federal adjusted gross income by $350.
You then carry that artificially lower number over to your state tax return. So your state taxable income automatically drops.
Meaning these educators get a parallel state tax cut without their local state legislatures ever voting on a bill or doing a single thing.
Here is where it gets really interesting, though, because we have to evaluate the broader structural critiques of this approach.
Broad-based tax policy groups, such as the Tax Foundation, caution heavily against the proliferation of narrow tax deductions, regardless of how sympathetic the target demographic might be.
Right, they warn about the unintended consequences of House Resolution 5334, specifically that it creates a very slippery slope in the federal tax code.
If Congress carves out a specific exception allowing pre-K teachers to deduct their mandatory work supplies, why stop there?
Why not allow auto mechanics to deduct the thousands of dollars of specialized tools they're required to buy for the shop?
What about home healthcare aides who frequently buy their own medical supplies or transportation fuel?
The argument is that you begin fragmenting the broad tax base into hyper-specific occupational carve-outs. Every profession can make a compelling argument that they incur out-of-pocket expenses.
If we connect this to the bigger picture, the most profound unintended consequence of this bill is entirely philosophical.
How so?
By permanently writing this specific supply deduction into federal law, the federal government is normalizing and institutionalizing the expectation that teachers should be paying for their own classroom supplies.
It acts as a permanent legislative band-aid.
Over the long term, this policy perversely alleviates the political pressure on childcare center operators, corporate childcare chains, and state governments to actually fund classroom budgets properly.
It permanently shifts the burden of equipping a developmental classroom from the institution to the individual low-wage laborer. You are legally codifying the dysfunction.
That presents a massive contrast to how the rest of the world handles these issues. When we look at the international models in our source stack, places like the United Kingdom, Canada, and Australia are facing the exact same macroeconomic pressures.
They have the same staffing ratios, the same ceiling on parental tuition, and the same severe teacher shortages.
But they do not use micro-incentives in their tax codes to solve labor shortages in early education.
The international approach is structurally different. Those nations address the systemic issues through direct public appropriations.
They utilize direct early career salary supplements funded by the state, and they implement structural workload reductions.
They view early childhood education as a system requiring direct investment into human resources.
Rather than asking the individual worker to navigate a complex tax filing at the end of the year to recoup a tiny fraction of their personal expenditures.
So to summarize the core takeaways for you regarding House Resolution 5334, this legislation provides long overdue statutory fairness.
It finally ends the arbitrary exclusion of early childhood educators, giving them the exact same tax treatment that K-12 educators have utilized since 2002.
Given the unanimous committee backing and the broad bipartisan coalition led by sponsors like Jimmy Panetta, Michael Bennett, and Susan Collins, advancing legislation is a straightforward process when there is uniform agreement.
Which makes it highly likely to become law. It provides minor, though mathematically limited, financial relief to a vital and severely underpaid workforce.
It is a highly targeted intervention. While the bill successfully achieves parity between K-12 and pre-K educators, it does not cure the systemic issue at the heart of the care economy.
It remains a symptomatic treatment that ultimately relies on individual tax manipulation rather than direct structural investment into the childcare sector to resolve foundational wage depression.
As artificial intelligence and automation continue to relentlessly displace traditional jobs across countless industries, human-centric roles, specifically in early childhood cognitive development, will only become the bedrock of the future workforce.
Which is absolutely crucial to consider.
If high-quality childcare is essential infrastructure for a functioning 21st century economy, it leaves you with a critical question to consider. How long can society continue funding this essential infrastructure by relying on individual workers to absorb the costs through individual tax loopholes before we are forced to treat early childhood education like a public utility?